What's up, Swan fans? This is Swan Signal Live. I'm Sam Callahan. I'll be your host tonight. I'm filling in for Brady. But welcome to the show. We got a great show today with some of our regulars, Mr. Andy Edstrom and Preston Pysh. But before that, some announcements. I wanted to give a shout out to Pacific Bitcoin. Swan is throwing a conference in November 10th and 11th. It's going to be the biggest Bitcoin conference in the West Coast. And we're going to have 3 stages: Swan Dome, basketball court, workshops, offsite parties, satellite events. And I'm pumped. It's going to be fun. I was there last week checking out the venue. And I know I'm biased, but I think it's going to be a really, really fun time. We got some great speakers. We got Jeff Booth, Robert Breedlove, Michael Saylor, Lynn Alden, and much, much more. Some of the greatest Bitcoiners out there are all going to be there speaking. Saylor said it's going to be the event of the year, and I have to agree. So if you want to get out in LA in November, get out to the beaches, go to pacificbitcoin.com. You can use the code SWAN for a 20% off discount of that ticket. Again, pacificbitcoin.com. Go check it out. Let me just show a quick little video of Pacific Bitcoin, and then we'll get into the show. All right, Pacific Bitcoin. Great. So this is our quarterly report, and I'm proud to introduce our 2 guests who are regulars. Mr. Andy Edstrom, who is the host of, he is the author of Why Buy Bitcoin, the only financial book on Bitcoin for financial advisors. And another is Preston Pysh, who is the host of the Investors Podcast, both legends of the game. You guys are familiar with these guys. They're here all the time, sharing their insights. And this quarter, we have nothing to really talk about, right, guys? Nothing's really happening out there. But how are you guys doing tonight?
Good.
Always happy to be here with both of you gentlemen.
Likewise.
Yes, I wanted to kick it off. And I actually wanted to read a little passage from this blog post I read by Pam and Russ Mertens. And it goes, "The world's financial markets have gone off the rails. The central bankers that had created bubbles in almost every asset class by keeping interest rates at 0 for years are now in competition for how fast they can raise interest rates in order to keep their currencies from collapsing. The dramatic spike in interest rates around the globe is causing prices to collapse in everything from stocks, bonds, commodities, and risk assets. There is nowhere for investors to hide." And I got a chart that came across my timeline from Dan Tapero, and it shows, if you're looking at the screen here, it shows the drawdown in total market capitalization of U.S. equity and fixed income. I mean, this chart is breathtaking. We're looking at $57.8 trillion of wealth essentially destroyed. And so what do you guys think when you're looking at this chart? I mean, it's pretty breathtaking. It seems pretty historic. Let me throw it to you first, Preston.
Well, I think the highlight is in the title there, that it just is U.S. It wasn't anything beyond U.S. was a 57 trillion between equity and fixed income. You hit on this idea. So we're now seeing inflation explode upwards. Well, we have probably for a year and a half. Have seen those numbers coming up. And I think for people, they're looking at it and they're saying, well, eventually it was going to happen. But the reason I think that you're seeing it happen is you're actually starting to break things already. You're seeing supply chains break. You're seeing distrust is, I think, the key word. Stephen Covey's son has a book called The Speed of Trust. In this book, he lays out a really simple thesis, which I think is really profound, is this idea that as trust goes down, the cost of things go up. And he uses an example in the book where he talks about, like, if after 9/11. Prior to 9/11, you could just go into an airport, you could go through security. It was quick, it was efficient. And after that, because trust had eroded, the cost of doing business has gone up. And so when we look around the world and we look at what's happening between countries, between municipalities, between states, trust is eroding between these organizations because they don't trust each other in order to make good on net exporters versus net importers. And I keep bringing this up online. And Lynn keeps bringing this up as well. And the reason we keep bringing it up is because if you just go to a first principles scenario, let's say it's Andy and myself, and we're exchanging value. And let's say Andy's providing hard goods. Let's just say he's giving me water bottles, right? And that's the hard good that he's providing. And I'm paying him back, but I'm paying him back in like these Lloyd Christmas Dumb and Dumber IOUs that I'm pulling out of a briefcase. And as I continue to pay him, after a while, he starts saying, hold on a second. I don't know that Preston's actually going to pay me back for these things. I think he's an idiot, and he's actually not going to make good on all these IOUs that he keeps paying me. And so what happens is that trust between those two parties starts breaking down. You're not seeing it at an individual level. You're seeing this literally at a global level. And so what happens? The cost of doing business goes up because you can't be trusted to actually make good on the energy that was expended to pay for that water bottle and to do that real work, the proof of work, right? To get the plastic, to form the plastic, to get this super high quality water that I filled up in my water bottle, because it's not actually Fiji water. I just like the bottle because all the bottles have become so cheap. But anyway, that's the example. And so like people need to play that out on a macro level. And when they're thinking about every single piece and part that goes into these complex things that people consume on a daily basis, and that they're coming from all over the planet and all over the world, we are interconnected. That trust is breaking down. That's the reason why you're seeing costs go up, is because the things that people actually demand, okay, are going up in value. And when you have a bond market that's been absolutely mutilated beyond comprehension, down to nothing percent through quantitative easing, because they're manipulating the cost of money and economic calculation at the heart of all of it, right? That has to somehow figure itself out and adjudicate itself. And so that's what we're up against. We're seeing it playing out in real time. And, what a time to be alive. What a time to be kind of right at this moment where, everybody listening to this probably all has the same thesis that Bitcoin's going to be how this gets resolved. And just excited to be here. Sorry to keep going on and on.
Hey, man, never apologize. Love it. Andy, do you have anything to add on Preston, or maybe your own comments on that chart? Like what comes to mind?
Well, just playing off of, I agree completely with what Preston said. And just to underscore that, despite the fact that I took a college degree in fiat Keynesian economics, there were a few useful things that they taught us. The trust factor that Preston was talking about is exactly right. It reminds me of Ronald Coase. He was a Nobel Prize winning economist. I think he actually just died relatively recently. And he had this idea. He had a couple of major ideas. One was about transaction costs. Another was theory of the firm. And the idea being that it's all about, economics it's all about scarcity, of course, but a huge factor in transaction and exchange is those transaction costs. And yeah, as the trust gets reduced, the transaction costs go up. This is another factor that Nick Szabo talks about with money and social scaling, right? That's why it's so important to have a money that everyone can trust. It actually, or I should say, a money that removes the need for trusting your counterparty, right? Where the monetary good itself is trustworthy, separate and distinct from whether the counterparties are trustworthy. And as far as where we are today in the world with debt, to cite another old Wall Street hand, Jim Grant, he always talked about debt being money of the mind. And that's where we are right now. There's been so much debt incurred that it's based on the expectation of getting paid back. And yet when that trust is fragmented or broken, then all of a sudden the money isn't there. Somebody has to go out and buy those debt claims that are getting issued at a faster and faster rate. And right now, the central banks don't want to buy them, although we're already seeing the first signs of capitulation in that regard with the Bank of England. And we shall see how it plays out with other central banks around the world, including the Fed. But it's been painful. It's been the worst in terms of value lost, across stocks and bonds. It's basically an unprecedented period.
Yeah, and I think it's really powerful, kind of what both of you guys touched on, this idea of trust. And over the last, say, 10, 20 years, maybe we've taken for granted how much those global supply chains worked. And then it all started breaking down very, very quickly. And so that inflation rises, the trust breaks down between countries, and now we wonder why the costs are so high. But let's go on, Andy. You brought up kind of the story of the day, month, year, I don't know. But the British pound basically collapsing on Sunday night after they kind of announced the UK Treasury announced plans for a 45 billion pound unfunded tax cuts on Friday, including those subsidy for energy. They freeze gas and electricity bills for the average household. Estimated cost is around 180 billion pounds or 6% of GDP. Well, the markets did not like that. And we saw pretty historic volatility in the UK bond market. I'm going to show a chart right here. It looks at the 5-day rolling average of the 10-year UK gilt. And if you're looking at this chart, I mean, it's historic, this move. Maybe ever, there's a little bit in the 1970s, but we're talking about a very, very historic move in these bond yields. It basically came close to a Lehman moment if it wasn't for the Bank of England coming in and reversing course abruptly and intervening in the bond market. So what did you guys think of this? It was pretty crazy to see it all play out. Let's throw it to Preston.
Yeah, so this is a massive deal. For people that aren't completely dialed into how big of a deal this is, like you said, this was a Lehman moment that was diverted within potentially hours based on what some folks are saying. The fact that you had the Bank of England last week announced their 50 basis point hike and their quantitative tightening, and then a week later, 1 week later, having to reverse course, right? Mm-hmm. And I think the number was 65 billion in order to support the yield that they want to peg. Now, whether they keep doing it or not, that's still up for debate, but I just don't, you're not fundamentally solving the issue at hand, which is, and here's the issue at hand, they want to reduce their taxes and they want to do all these fiscal things, and they don't want to have to pay for it. It's that simple. And so when you're in that scenario, and going back to Lynn again, Lynn has some amazing papers on what actually manifests inflationary impacts that you see in the market. And it's a combination of quantitative easing with gross fiscal spending. And when you combine those two together, which is exactly what they did today, and here's the other kicker. They're a double-digit inflation, and that's the number they're telling you. They're a double-digit inflation. So if they didn't make this move today and step into the market and manipulate the market, you would have had the pension funds blow up, because the numbers that I saw is that the yields would have blown out to 7 or 8%, and they were already in the 4s. So think about how insane that is. That is nuts. The pension plans in the UK would have gone to nothing. They would have blown up. That's how precarious this situation is right now. And we're just getting started. We're just getting started in this clown show.
Yeah, I read 90% of the pension funds the collateral would have.
That was the number that was quoted in Financial Times, I think.
That's insane. Andy, what do you think?
Yeah, I think when I look at Britain, it's important to remember history, and I think it may be useful to think about it as a case study for ourselves here in America. Britain was the global empire, and they declined from that position. And Britain is an island. So historically, you had this expanse, this empire, this great power that learned to extract resources from its far-flung holdings across the globe and compensate for the fact that it had, could do certain things at home, but it had to trade for other things. Oh, and one of the things it had to trade for is energy, which is actually pretty ironic considering, the coal deposits fueling the Industrial Revolution that brought Britain to power in the first place. But now they're on the back foot with respect to their sources of energy, ironically. And when you have a free-floating currency and your economy is decent size, but not nearly as large as the economy of the world's global reserve currency, that's America, well, then if the Fed starts to make moves to tighten and you're an island economy, the valve basically for adjustment is the currency, and things can move really quickly. Now, the good news for us in America is we have a much larger economy, relatively speaking, than Britain. And even if we were to lose our positions across the globe, or at least some of them, we have huge resources domestically. So I don't see that outcome in the future for America necessarily, but it is interesting to think about how these things play out and how history plays a part.
Yeah, that's a good point. And to Preston's point, like how this is just getting started, I'm going to throw up more charts here. But this is our friend James Lavish showing the credit default swap spreads of, the gilts, and it just goes vertical. And this is after the Bank of England stepped in, and then it actually increased another 6 points into the close. And so this is showing you that, investors are not happy with this intervention, and they're still worried about a potential default happening.
It's showing you that they still have it on their books, and they have to do something in order to hedge that. So, at the end of the day, I think the Bank of England at this point has demonstrated that they're going to step in. They're going to be there to support the yield, and they're not going to let the yield blow out much further than where it's at right now. And, these entities that are still sitting on these things have to go out and demonstrate some type of work that they're trying to do something about it. But that's I think all that's showing you.
Well, is that so? Like you got all three. You got
Andy seems like he disagrees.
Well, no, I want to talk about this concept of sovereign CDS, because I ask this question now and then. I still feel like I haven't got an answer, which is, who thinks they're getting paid on a sovereign CDS contract, right? A CDS contract is designed as an insurance policy whereby if there's a default of the issuer, that you're issuing the contract on, okay, then the other side of the contract pays up. And so, yeah, my question is, what scenario is the financial system solvent and your counterparty solvent, such that they're going to pay off on that contract? I don't get it.
I think that's why Greg keeps saying that Bitcoin is the true CDS.
I guess that's Bitcoin's the true CDS. I think
there you go. There it is. But I think your point, maybe the answer, Preston, maybe that's the answer, is the need to hedge, and therefore, make it look like you buy the contract so you look like you're hedged on the assumption that you're going to get paid, despite the fact
Don't lean in me. I'm trying. Right. I'm too big to fail. Don't lean me. And that's all it is.
And by the way, just so we're clear,
game, right?
Yeah, it is all big game. And just so we're clear, I'm not saying that the UK is solvent and that all these sovereigns are solvent. I'm just saying that in most cases they'll just print the money, and in many cases they can print the currency, and that is the basis of the contract, that you're insuring on.
So the question then becomes, like, where does it go next, right? So it showed up here. Everybody was seeing the spike in the dollar, and you're seeing the zero hedge tweets, and you're seeing everybody saying, all right, something's about to break. It always breaks when it gets to this point here where you see the dollar blowing out. So what's going to break? And then within 24 hours, we found out what was going to break, and it was in the UK. So now they're plugging this hole. And the Bank of England looks like total idiots because they reverse course from what they were showing as strength, and now it's weakness within 7 days. So now where does it go next is really the question, and how does it manifest itself? I don't have an answer for you. I just know it is going somewhere else because nothing has been fixed, fundamentally fixed, right? And that's how everybody's got to look at this. You just got to look at the trends. We know where this is going, which is them reversing course and dumping insane amounts of liquidity into the system. And here's the other thing: as long as they can continue to plug the holes and try to hold this thing back, the response that is going to be required is going to be that much more, have that much more magnitude to the response. Like if they reverse course right now, they don't have to do nearly as much, and then they can keep playing this game and dancing around. But now they're in this spot where the inflation prints are getting so out of control that they have to try to break something. But the problem is that as they break it, that number that you showed right there, no, who was that? Is that you, Andy?
That's right. That was former Bank of England chair Mervyn King calling you at Preston and telling you to stop talking, please, because you're not holding up the party line.
So I think the point I was trying to make, as we were rudely interrupted, was $57 trillion just poof, it's gone, right? And so that's in capitalization, that's in cap rates of bonds and equities. And so as that's compressing down, and then they're stepping into the market, and they're only adding 65 billion to the BOE. They're only adding 65 billion is what they're saying. Now, who knows if that continues on? But when you think that number of 65 billion versus the trillions that are evaporating, it's a little hard for people to understand how levered the system is, that they can step in and do these little tweaks with $65 billion, and it has this profound impact in market capitalization of equities and bonds. And so this whole system is getting so levered and so precarious. When you look at something that you only move a centimeter, or as some people were describing interest rates in inches, as you're adjusting things and call it a centimeter, and it's moving a mile. That's what's playing out right now in financial markets because of how capitalized and how levered everything is. That must have been Andy too.
So
I'm spamming you, Preston.
So when we're looking at the dollar, though, so Preston, on your last quarterly report, you said the power of the dollar is wrecking everything, especially compared to Europe and Japan. It's like an infinity stone in one of these Marvel movies where it is so powerful you can't touch it, especially those with dollar-denominated debt, as the dollar gets more powerful. And so what we're seeing is basically the Bank of England, the ECB, and the BOJ all performing some kind of unlimited QE at this point. And then you have inflation raging in all of those jurisdictions. Is this just the outcome that we should expect from here on out, for this just to be the new normal, where unlimited QE while inflation is raging? Like, do they have any choice? Because I feel like they need to prop up their currencies because the Fed is hiking rates at such a rapid pace, and their currencies are getting damaged from that.
You got to look at these locations, right? Like here in the US, we don't have major energy independence issues like Japan, Europe, UK. And so when you look at what they have to do from a fiscal standpoint to offset this gross net importer imbalance, and what is the imbalance that they're demanding? And it's the most raw, essential thing that mankind needs to do anything, which is energy. Right. So when you look at that lens, and you look at the fiscal spending that's required for that, and then you look at where their credit markets are at, it all makes sense why you're seeing them have to use the currency as the relief valve here. And when you look at the strength of the dollar, it's real simple. It's just relative to every other currency, and they all suck. And you hear, Foss and others say it's, the cleanest shirt in the dirty laundry. And that's what it is. And right now it's extremely clean in the dirty laundry compared to everything else. or everything else is super dirty, right? Whatever analogies you want to use, that's what we're dealing with.
What about you, Danny?
You got to think about the fate, right? You got to think about, okay, they got basically three mandates. They got employment, they got inflation, and then they've got, functioning of the financial system, right? Financial stability. Okay, well, unemployment is extremely low still. That may be changing. We'll see how that goes. But in terms of the actual numbers that are showing up on the books, unemployment is quite low. Inflation is out of control, right? It's higher than it's been in 40 plus years. And then financial stability is still intact. So we're seeing more difficulty with financial stability, right? We're seeing some of these foreign central banks start to say uncle, and we'll see how that plays out. But unless and until there's real mayhem in markets, and unless and until stuff really starts breaking to a greater degree, the Fed has to maintain its credibility and keep going. Jerome Powell does not want to be Arthur Burns. He'd rather be Volcker. And then moreover, the election cycle is pretty interesting, right? Inflation became the major problem. So now we got the screws turning. The midterms, matter. And so the hope, I think, of the administration is to get reductions in inflation, at least at the margin, right? Set the trend in the right direction in time for midterms. But then the real priority for the administration has to be the 2024 election. And there's still time to engineer a recession and then reverse course. I'm talking about from the Fed's perspective, just in time for the 2024 presidential election. And I think that's kind of what you see in the futures markets, right? That's what you see in terms of the market's expectations on Fed policy and rates. Now, we don't know what's going to happen with the rest of the world. And, if all hell breaks loose, then all bets are off. But I suspect that that's sort of the political angle, and that's probably what's in the minds of Powell and crew.
I hear what you're saying in terms of the Fed's mandate and focusing domestically, especially with inflation raging. But isn't this kind of like the Triffin dilemma, where there's like a conflict of economic interests between short-term domestic issues and long-term international issues? And if they're raising rates and it's wrecking all their allies' currencies and economies, at some point, don't you think the Fed has to consider the international impact of their policies, and maybe that could cause a pivot? Or do you think they're just going to focus on their mandates and just focus on domestic issues and just whatever happens to BOJ, whatever happens to England, like Europe, doesn't really matter?
Yeah, it absolutely is causing the Triffin's dilemma through and through. And I don't have a good answer for you, because I think up until we started to see inflation, it wasn't hard for them to globally coordinate, because there was really no impact to that, at least that was seen by citizens, where you were getting social unrest. You weren't seeing that. But now that you're starting to see social unrest and you're seeing political, I don't know if I want to call it extremism, but you're seeing the polarization of politics really kind of flare up, because there's so much social unrest and dissatisfaction with what's playing out. People don't necessarily understand what's playing out. They just know there's something seriously wrong and they want change. And so if you're on one side or you're on the other side, you're just pointing your finger and saying they're the reason why, and they need to be replaced. And so when you look at this from a global lens of what's the U.S. do to solve this issue over in Bank of England, they've got to ease the dollar, because that's part of the problem here. I don't know that I don't know that it's as easy as it's been for decades for them to just easily roll over and say, oh yeah, we'll just ease up on the dollar at this point, because everybody knows what ramifications that's going to have for markets, because it's going to be viewed as a major pivot. So, I think that game of global cooperation, it goes back to the very first thing we were saying, which is trust is breaking down. Well, it's breaking down between central banks too, where it was real easy. We just all went to Jackson Hole and we all got along. And you know what? We're just going to ease a little bit here, and then you guys can start doing it next year. You can see it in the charts. Look at the central bank balance sheet charts, and if you plot all of them out, right, the main four: Bank of Japan, Bank of China, the European Central Bank, the Fed. If you look at their balance sheets and you plot it out, and you consolidate them into dollar terms, it's just like this perfectly straight line since 2008, right? Like that doesn't happen by chance. But now I think you're starting to see some serious headbutting that's kind of taking place in this expectation. Like, I thought we were friends, and maybe we aren't as close as we thought we were.
Yep. Well, one of the things, Andy, you brought up kind of the smooth functioning of the financial markets, and people talk about the Treasury market breaking. That's the thing, right? That's the thing that could maybe cause the Fed to pivot. March 2020, we kind of saw that happen. And another chart for you guys, Jim Bianco had this great chart. The Bloomberg United States Government Liquidity Index looks at the Treasury market liquidity. That's up at levels not seen since around 2010. And so we are seeing kind of dysfunction start to happen in the Treasury market. And you look at the kind of the move index, same thing. You're seeing that really start to rise right here up to levels not seen since 2009. We know what was going on around then. Wasn't exactly good times. So what are you guys looking at the Treasury market and seeing? Because it seems like these yields are moving awfully fast, and it's pretty scary to see, to be honest with you. So what are you thinking about that?
This has been the big surprise to me of this year, which is that amid such rapid tightening of financial conditions, we still have more or less orderly and functioning markets domestically. I mean, we talked about the foreign stuff. Yes, those charts show some signs of stress in the Treasury market. Still auctions are clearing. Still, these markets are deep and liquid. Somebody is buying that paper. And so, yeah, I mean, I'm watching with bated breath to see what's going to happen with treasuries, as well as other, quasi guaranteed debt, talking about the mortgage agency debt, as well as the housing market. I mean, the housing market is by far the biggest asset class in the US and arguably globally, and it's very levered. And so we're going to see what happens with housing, and as goes housing, so goes the economy. Clearly indications starting with respect to stress. And the surprise for me has been that we haven't seen greater mayhem already, given the pace of tightening.
Sam, I'd like to cover it from kind of a business lens. So if you're a mid to large cap company, let's say you have multiple contracts that are 100 million plus. The way a lot of those contracts are structured is they might have a base year, they might have option years, so that they hire somebody, then that company hires a bunch of subs, and then they have subs underneath of them. And so let's say we're just talking about like $100 million contract between two mid cap to large cap companies. So when they set these contracts in place, let's say they make an award for the base year, and then you have another 4 option years on top of that where they can make those awards if it's advantageous to the one party, if they still like the product that's being produced. When you get into numbers of commodities that are this violent and volatile, what happens is in contracting, you have firm fixed price contracts, you have cost plus contracts. These companies that have signed up to a firm fixed price contract that have option years, call it for anywhere from like 3 to 5 years into the future for deliverables, they're getting wrecked, just like the bond market, because that company that decided to sign up to that work and perform that work for 3 to 5 years into the future, we're making assumptions as to what their material costs were when prices were, really low inflation levels, prices were much more stable. And now look at things. the volatility in the prices of everything is all over the place. So how do you cover that if you're a business? You have to own derivatives contracts if you're truly going to cover that cost. So it doesn't matter if the price is going up or the price is going down. A person who's in business is looking at that and saying, I've got to price myself. I've got to price for that volatility to protect myself. Now, let's talk about margins on a contract like this. After-tax margins. You can just look at 10Ks and 10Qs of companies and realize that they're, if a company's banging out like 10% after tax, they're doing pretty darn good, right? If you're doing super good, you're at like 15%. And so when we look at what it would cost, and when you think about the cost of $100 million contract for a piece of material, a complex component or piece of material, so much of that is the material itself, and the other part of it is the labor, which is also going through the roof, right? So if this company is only having 10 or 15% after-tax margin, but they're having to cover down on a derivative contract that for price swings in the commodity that they're buying, like those derivatives can make up 10, 20, 30% of the overall cost of the material that they're procuring. Like, it's a wrecking ball. Okay. So when does that manifest itself into the economy? It manifests itself into the economy in the out years, because if you were the person who was on the buy side of a contract, firm fixed price that was established this way, well, there's no way in hell you're going to not try to exercise those option years, because you're crushing it. Because if you stand up a new contract, like, you're going to get killed. So these are the things that are happening in everyday business. These are the trillions of dollars that are being exchanged around the world are all in these massive contracts between entities. And this is how they're constructed. This is how these businesses are thinking about it. And if you don't think that that's going to have a little bit of a lag to it, you're kidding yourself. So although, like Andy said, he's surprised that everything's still functioning, I agree with him. But I think it takes a little bit of time for a lot of the real implications for what's actually being performed in a real economy, which I think so many central bankers haven't spent a second in reality in a real business, awarding a contract, doing work, building complex parts and components, and then delivering it. Right? Because anybody who actually does that understands all of these types of things that are going on and how profound they are in the tail on the timeline.
Yeah, the volatility in the Treasury market just kind of bleeds out all downstream. Just this distorts the price signals about the whole economy. Anyone's trying to plan, anyone who's trying to do anything business-wise, it makes it a lot harder. But that actually brings me a point, because one thing, and you brought up maybe it's a lag effect, but the stock market has actually held up pretty good this year compared to what everything else that's going on. I mean, it's down the indices.
Where's all the selling in the fixed income going to go?
Yeah.
Where are you going? I think that's probably the question, Andy, here's the most. I'm sorry to interrupt you, but it's like all that buying power, the 57 trillion that just went kaboom, where did it all go? And it has to go into something that has scarcity to it. It has to at this point, because the economic calculation has been absolutely destroyed, right? So it has to go into something that somehow functions and acts like a scarce thing. And so you have equity, you have commodities, you have Bitcoin, and there's not too much else.
Yeah.
So here's a spoiler. Here comes the wet blanket. You know what I hear from a lot of clients right now? Man, treasuries look pretty good. 4%, man. You can make 4%. It beats losing money in the stock market. Now, granted, that's 4% paid in dollars. And so, it's a relative value trade as compared to all the much worse, garbage debt that's out there floating around in the world. But yeah, the relative spread between equities in a rising rate environment and treasuries yielding 4%, we were so out of whack before in terms of where the valuations were, that is too high in equities in retrospect, and where the yields on government bonds were, which was way too low. And so that really broad gap between those two asset classes has come together a decent amount. And I think I agree with Preston that in the longer run, you got to own something scarce. Commodities are a good play. And I'm just observing, like, where I'm seeing capital flow in my little world, and people, believe it or not, are saying, "Oh man, 4% for no default risk. Even if I lose something on the currency, that doesn't sound so terrible at the moment."
Yeah, it's looking a little bit more attractive. So you think it kind of pull some flows out of equities into these, quote unquote, risk-free treasuries. So that makes sense to me for sure. I'm just kind of surprised by the strength of it. And then, the VIX is still around 30. I mean, despite all these crazy things happening around the world, the stock market the volatility there has still remained kind of suppressed. And so it makes me think that we're still in for maybe some kind of liquidity event in the future where we see that VIX spike before we see any kind of like bottoming process or anything like that. Like, do you guys agree? Do you disagree? I know, stock market is something like the bond market is the dog that wags the tail. So we should focus a lot on there. But the fact of the matter is a lot of people still own stocks and they want to know where this market might be going in the future. So any kind of just broad-based predictions of where you see the stock market going? Say in the
All right,
next
so I'll take the long-term view. I'll take the cop-out long-term view. I'll take the 10-year view so that I'm safe no matter what. So that by the time we know what happened, a lot of time will have gone by. The way I think about long-term for stocks from where we are today is that it's probably going to be a rough decade, right? It'll be a good outcome in my book if a basket of equities keeps pace with inflation on average. And I'm not talking about like this year or next year. I'm just talking about as this whole geopolitical and debt situation and currency money situation resolves itself this decade. And then, of course, the question is, well, what are the alternatives? And the alternatives are, we know one that we like, which is Bitcoin in the long run. And you take your lumps and you take your pain on the volatility, right? You avoid leverage, you dollar cost average, and you take a long-term view. And, in bonds, you assume that despite the fact that you may have higher rates than you did on average in the last decade, you're going to lose ground to inflation. And so I got to say, I think this decade is a decade of treading water and or getting poorer for most people with diversified investment portfolios. And I think there's precious few assets that are going to outpace inflation. And I think that's just the reality in my base case that we face for this period known as the 2020s.
I think it's pretty straightforward. I think the markets are going to continue to struggle. The equity markets are going to continue to struggle until they see a aggressive pivot from the Fed. I mean, it's just math, right? It's when I'm looking at the inflation print. What was the last one we had, Andy? Like 8.3 or 8.4 or something like that.
Yeah, mid-eights.
I mean, it's massive. The calculations when you're doing a discount cash flow analysis, and you're using some type of discount rate or IRR, like you're in a different universe when you're comparing it to the inflation rate and expecting that you get a premium above that in your yield. So when I'm looking at it, I'm saying, okay, well, that's impossible unless they reverse course and start doing, this massive drop of more monetary units into the system. And until then, it's going to continue to struggle.
Let's talk about the Fed, because the Fed is still talking hard. Like they're job owning. Kashkari is coming out and saying we will not make the same mistake of raising rates when the economy weakens. And you have Jerome Powell basically saying like we need higher unemployment. We need a softer labor market conditions. And so TLDR, for the people who don't speak Fed, the Fed's plan is to wreck you to get inflation down. That's kind of what their plan is right now. But do you think that what we're seeing in the UK is just going to foreshadow what's going to happen over at the Fed? You know, whether that's next year, you know, does it all just end in the same kind of panic pivot of hey, we tried, but we got to go back because it is just math, and we need to just go back to doing what we were doing before, which is unlimited QE. Do you think that this is just a foreshadow to what the Fed's going to have to do?
So let me take it real quick. So I had dinner with an old friend 2 nights ago. He's a smart macro thinker. His name is Matt Fair. I used to work with him in a prior life. And he was telling me this really sort of bearish deflationary story. Like, you know, the Fed's not going to stop. They're going to force a bunch of pain. It's going to be, you know, much higher unemployment. You know, stocks are going to go down a whole lot more. You know, we're maybe halfway down in terms of the, you know, the bear market. You know, we got another, you know, down 20% to go, or whatever that is from here, down 25%, et cetera, et cetera. And I'm taking the counter view, like really, do you think financial stability continues in that kind of an environment? Oh yeah, they're gonna, it's politically expedient. You know, the rich got too rich, so we're gonna take them down a peg, and you know, and then he starts talking about UBI, and I'm like, okay, so you're really bearish / thinking about a deflationary scenario. I go, what's the probability you put on that outcome? And he goes, 20%. Okay, well, how about the other 40 or 50 or 60% scenario? And that's where I still am, is that we get the pivot at some point. Now, nobody knows how much pain there's gonna be. Maybe these latest ructions in the Forex market are indicative that we're close to that pain point, to that pivot point, which makes you think that you gotta have some more mayhem basically before that pivot. But I still think that the inflationary, you know, number go up, start the money printer again scenario is the more likely of the two. It's just easier.
Yeah.
So this is how I would equate this. Creative destruction's a good thing, right? If you have a economy that is healthy, meaning it's diverse, it has a lot of different small cap, mid cap, large cap companies, and there's actual energy exchange between the participants. Creative destruction is really bad when you're on your final hours of your life, right? When I look at the market today, it is a disaster. This is like having a grandparent that's 98 years old and in a wheelchair, and forcing them out of the wheelchair and saying, "Get up, work out. You gotta get going here," right? You got to get going, because if you don't work your muscles, you're not going to make it. That's what's playing out in the global economy right now. They are trying to exercise all of the sudden, after literally bailout after bailout after bailout for these banks that have grown to behemoths. You know, if this was like a forest, you don't have the diversity in the forest anymore. There's like one species, and that species is demanding that they're not messed with. You're not allowed to have the wind blow anymore, because if it blows even 5 knots, the whole forest is going to fall over with this one species that continues to exist in the forest. That's where we're at.
Yeah.
So when people are saying, "Oh, we're going to remove the demand out of the system by tightening the money supply," all of a sudden we're going to tighten it, right? They're forcing the 99-year-old grandpa to get out of his wheelchair and start working out and start bench pressing 350 pounds. That's what they're doing right now.
Yeah, it's a little too little, too late. Creative destruction is great, but after 10, 15 years of this, and they're letting this build up, now it's destructive what they're trying to do instead of trying to. Yeah.
The mistake that people are making, and I'm not trying to sound like a doom and gloomer, I'm just being a realist. The mistake people are making is they're thinking that the existing system is salvageable. It's not. It's not even close. And so you have to think about, okay, so how does this thing resolve itself? What's the life raft? What can catch $300 trillion worth of buying power in these credit markets, right? In a secure way, in a decentralized way that nobody can come in and screw with. Nobody. Because that's what's going to catch all that buying power.
I think he's talking about Bitcoin, Andy, if you were wondering.
I thought he was talking about cast iron skillets. I thought we were going to monetize cast iron. But I'll take
you're, you're totally
I'm
right.
not entering into that debate.
Yeah, what's gonna take all this out of the bond market? It's gonna be Bitcoin, and let's talk about Bitcoin. So I wanted to close with Bitcoin. We got to touch on it. I wanted to show a Drunken Miller video from today, but let's just share a quote that he did. He said, "I believe that there might be a renaissance in cryptocurrencies if trust in central banks fade," which I think was a pretty notable quote from a man of his stature. You know, one of the best investors of the last modern times. And Bitcoin's actually been pretty resilient since June. It's pretty much been bouncing around 18 to 23. It's kind of its own little stable coin in a way. And so what do you guys think about that resiliency? Because I'm looking at these major currencies collapsing, and in my mind I'm thinking this is exactly why Satoshi Nakamoto invented Bitcoin. Like, he saw this end game that we're going through right now, potentially. And here's Bitcoin, arguably stronger than ever from a fundamental standpoint. You look at, hash rate, you can look at number of wallets, all kinds of these fundamental metrics that you can look at. And I'm like, wow, when are people going to wake up to this thing? Because I still feel like people are sleeping on it.
Yeah, and here's here's where your unit of account matters. If you're Japanese, if you're a Japanese buyer of Bitcoin and you measure in yen, Bitcoin's doing pretty well in your domestic currency, which is one of the major currencies of the world. Bitcoin's price is doing very well. Likewise, the pound, even in euros, it's performing quite well. So it's only if you're measuring in dollars, which most of us do, that you have any significant doubt about what's going on with Bitcoin. I think the tourists are gone. The momentum traders are gone, right? The guys who bought it as a quick trade, they're out of the trade. Much of the leverage is gone. Never say never with how much pain or leverage liquidations you could get with another wick downward. But a lot of the nonsense, has already flowed through the system. The red notices have been issued. The bad actors are already on the run. So yeah, I think it's indicative that the cycle for Bitcoin price in U.S. dollars is playing out as it has in prior cycles in terms of the shape of the bottom. And so, yeah, I mean, I think it's a great place to be accumulating dollar cost averaging over time. I'm not going to call a bottom, but that's how I see it.
Eventually, you run out of sellers, and in this space, you have some really hardcore psychopaths that, I don't want to say they enjoy the downturn, but some of us do.
Some of them are in the chat right now.
Yeah. And I think because this is why I think people have grown to, when they look at this and they see it, they know that there's nothing somebody can do to manipulate what they hold and what they have. And that's insanely profound and insanely important. And once you get that, and once you understand it, and once you can look at on-chain data and see that there's a certain category of people that at 20,000 are deep, like absurdly deep in the money still. And guess what? They still hold quite a few coins, and they're not going away, and they're not going anywhere. And so when you have that type of conviction for what's being done here, and you have that base, that bedrock type holder, that's something that I think is lost on so many people that are outside this space. And like Andy said, the speculators are nowhere to be found right now. They're gone. And that's good because the long-term holders, as they continue to consolidate free cash flows, are going to just continue to stack more and more of these things on top of Bitcoins, on top of the massive pile that they already have. And so when we go into this next liquidity event, and then the fallout and the response, and they drop ungodly amounts, trillions of fiat units back into the system, you're going to watch this thing just rip. And here's the thing. You don't need to know when it happens. You don't have to ask that question. You don't have to pinpoint the timeline, right? Like, people know I've been stacking cash for 2022, right? Don't do that. just keep buying. Buy whatever percent makes sense for you in your personal situation to protect yourself, like Greg Foss says, as an insurance policy against this debauchery that's happening in these non-free and open markets. Bitcoin is free and open. It's the only thing I can find out there that's free and open. So it's going to be exciting. You're at a very exciting time. I pray every night that as we bridge to this new system, that the least amount of people are hurt or impacted in a negative way as possible. Because I don't want that. I want everybody to be able to enjoy the benefits of this new system that's being constructed. And I think it's going to be insanely favorable. It's going to be insanely optimized for efficiency, because you don't have somebody in there trying to play God with how economic calculation should be being done, not how they might want it to be done, as they're acting like puppeteers with their strings as they try to control everything.
Couldn't agree more, man. And these are the times where, stacking during these drawdowns, historically, this has been a good time to do it. This is why at Swan, we recommend Bitcoin savings plans, because we think it's probably the best way for a majority of people to get exposure. And then the long-term holder supply right now is at an all-time high. So exactly what you were saying in terms of this convicted base that will buy at any price. I mean, that's looking at the total circulating supply that's been dormant for greater than 155 days, and is a good proxy for investor holding behavior. It's at an all-time high right now. It's like 13.262 million Bitcoins are dormant, which is, it's pretty insane. So I got one more question for you guys, and it's just, I want to know, I need a prediction. All right. We do this every quarterly report. I need a prediction for maybe the next 2 quarters. I'll give you a little bit more time. It can be a Bitcoin prediction. It could be something else. Give me something that you guys are thinking about. And then we could check back at the next quarterly report and see how you guys did. You guys are pretty good usually, by the way. Who wants to go first? Nobody wants to.
If
I predict,
you didn't have the
Taylor,
BOE,
I predict MicroStrategy buys more Bitcoin.
Taylor cop out. I love it. Okay. Andy, good.
Here's a cop out. If the BOE thing didn't happen today, I would have suggested that I expect something really big to break within the quarter. We obviously, I don't know how much longer something else is going to take to kind of manifest itself, but I think you're within a quarter or two before really seeing fireworks in the broader markets. Now, whether that means that they pivot or not here in the U.S. with the Fed, I think they're gonna have to do something. If the dollar goes up to 116 to 120 on the DXY, like, it's gonna break things. Like the rest of the world can't handle with the dollar denominated debts with the DXY like that.
All right, here's a specific prediction. Fed opens up large scale, very significant dollar swap lines with major foreign central banks, Japan, England, ECB. That could definitely happen. And although that, creates more dollars in the system and is a pivot of sorts, depending on what happens with those base dollars, they could be deemed non-inflationary, and they could also help save those major foreign central bankers that are squirming in their seats right now. So How about sizable swap lines?
I like that. I think that's a good prediction. All right, guys. Well, thank you so much for your time. We're going to head over to Twitter Spaces for the second half of the show right now. So get your questions ready for these two gentlemen. Both of these gentlemen are going to be speaking at Pacific Bitcoin on November 10th and 11th. So pacificbitcoin.com, go check it out. And get your questions ready. Twitter Spaces, it's going to be a good one. I think there's some other friends, let's say, over there that I think it's going to be a spicy conversation. So thanks, guys. I appreciate it.
Thanks, Sam.
All right, guys. I hope you enjoyed that show. It's a pleasure to host and fill in for Brady. Can't wait for that guy to be back here. Thanks to Preston and Andy for those great conversation. So, at Swan, we really focus on education. We think it's incredibly important to educate Bitcoiners, not just to own Bitcoin, but to understand it so it gains conviction. There's a great chart out there that looks at how much you own versus how much you understand. And we believe it goes straight up to the right, because once you start learning about this thing, you say, wow, this is great. I'm going to buy some more. So with our educational efforts, one of our newest shows is Hard Money with Natalie Brunell. I work in the research part of this. I'm a small part of it. It's a great team, Swan Studios. They put a lot of effort into every week putting out a high quality, well-produced show that mimics just like the mainstream news shows, except it's Bitcoin, and it actually tries to deliver truth. And I really respect it because Natalie's such a pro. And so check out Hard Money. It's on a new YouTube channel right now. You can go over there, subscribe, please. It helps us out, helps us gain a following. And again, we're just trying to spread signal. We're trying to educate people about Bitcoin. And I believe Natalie's a great way to bridge the gap between maybe Bitcoin Twitter and the mainstream. She kind of delivers things in a way that's super accessible. And I think that's important for Bitcoin adoption. So we're going to play a little Hard Money ad just to kind of show you what's going on here.
Hello and welcome to Hard Money. I'm Natalie Brunell. Bitcoin remains in the high Hope House here in El Zante. It is a community center that does outreach at Bitcoin Beach. Look, they even got their own Bitcoin mobile.
I want to start a Bitcoin caucus with other elected officials across the political spectrum.
It turns everything brighter. Magic money, baby.
Goldman Sachs has offered its first Bitcoin-backed loan for cash.
Everybody knows the word Bitcoin.
The Bitcoin. Oh, Bitcoin.
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 Sí. Economic freedom with Bitcoin.
On Hard Money, we'll bring you the top headlines of the week with analysis you won't find anywhere else. I'm Natalie Brunell. Welcome to Hard Money.
All right. Thank you, everybody. Head over to Twitter Spaces.